premiums have been such a skyrocket in the last few years.
So how did we get here? So there's two major drivers in how we got here. Those two factors together have driven up the cost of insurance. Oh my gosh, 300%, sometimes more. Those two factors alone are essentially causing the insurance crisis.
Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Gretchen Francis, welcome to The Debt Doctor.
Hi, Bill. Thanks for having me.
I am so lucky to have met you, and we are going to have a great conversation. I know people don't think you can have a really interesting conversation about insurance, but we will make it so, I promise. I'm so happy to have been introduced to you. You have saved me a lot of money. You've taught me a lot about the world of insurance. You know what? I can't do it better than you. Tell us who you are.
Sure. So my name's Gretchen Francis. I'm the managing director at InsurMac. We met through a mutual friend in the industry. We specialize in lender-placed insurance and also REO insurance and also REI insurance, so property investors. I've personally been doing this over 15 years, and everything else you said is correct. I did save you a lot of money, hopefully made your life a little bit easier as it pertains to dealing with insurance. And we're just happy to have you as a client and happy to be here.
You know, it's funny because when you say you've been in the industry 15 years, I don't understand how you got into the industry as a teenager. It just doesn't make sense. It does not compute. So, but you spent a lot of time in one of the big players in the industry. And, just to clarify for people, you said it and I want to repeat it. You're not a retail insurance person. You don't sell homeowner policies to individuals. You deal with investors like ourselves that are buying portfolios of either real estate or mortgages. And so you shop those larger policies, that blanket policies over multiple properties, to the major carriers like Lloyd's. That's correct, right?
Exactly. And if you back up 20 plus years, I actually started in banking. So I came from the lender side and then I moved over into insurance, and I've been doing lender placed ever since. But you're correct. We don't represent the borrower or the homeowner. Technically, we could. I mean, we're property and casualty insurance brokers, but that's not our specialty.
Mm-hmm.
We advocate on behalf of the client, being the lender, the servicer, the real estate investor, and we sell what's called a master policy. Some clients like to confuse that with a blanket policy, but they are two different things. So a master policy requires you to tell us the list of properties that you want to insure, and then we make sure that those properties are insured, regular monthly billing, and provide those services around, making sure that if you acquire a portfolio, that it's properly insured. If you sell a portfolio, that we get it removed and you're not continuing to pay that insurance.
By the way, just as a side note, what got you into this? Like, you're actually passionate about this stuff. Like, why?
I actually really do enjoy what I do. I know, I guess there's not a lot of people that say they love insurance, but I truly do
I
enjoy
know.
it.
Doesn't make sense.
Um,
Come on.
there is a story. When
Okay.
I was previously in banking, and I loved that. My family was in banking. I loved the banking industry, but this was the mid 2000s, and after the crisis and everything, and I was looking for something different. And so I was just looking
Hmm.
around the area in Cleveland. I'm from Cleveland, and there was a job opening online, and I applied for it. It was insurance related, and I didn't really know much about insurance at the time, but it was lender insurance related. So I thought, well, I'm coming from a lender, and so I sent in my resume, and I got a pretty quick denial. And I remember like that was a turning point because I got this denial email, and I thought, "Ugh," and I could have just hit delete, and that would have been the end of my insurance journey. But instead, I replied to this denial and I said, actually, I think I am good for this position. And here's why. And I listed out the reasons. And that was the beginning of my insurance journey. And here we are 15 years later.
There is some psychology we can get into on that one. What other things have you been told you can't do that you went on to prove to the world that you could?
Well, I guess the rest is to be determined. Um, I think that was certainly a pivotal point in my career trajectory. Certainly
Yeah,
starting in Shermack a few years ago was another pivotal point. When I saw the opportunity
that could be
in,
it.
yeah, not just to expand and continue what I was doing on the lender place side, but also expand into the commercial side. Because post COVID, there's a lot of activity and loan issues and resolutions and REO that a lot of stuff is going on in the commercial world that we saw similar activity back in 08, 09 in the residential world, which means there's a lot of opportunity. There's opportunity for investors. There's opportunity for insurers. All kinds. I mean, unfortunately, that also means that sometimes there's not so friendly
Somebody's
things
going to
that
take
are
a
also.
loss in
Yeah,
order.
exactly. But I can't control that, and that has nothing to do with me.
Right,
But what I can do is assist with the recovery and the insuring of some of these properties that are sometimes
right.
uninsured, underinsured, can't get insurance, and that's where I come in.
I just find it fascinating how people, choose their paths in life, and that we can all point to inciting incidents. I mean, I speak about it all the time when I talk about how I got into buying mortgages. It was a fateful phone call the
Mm.
summer of 2008. 3 months before the fall of Lehman Brothers. And I was like a real estate fix and flip investor. I had a commercial brokerage. I owned a bank location. I, was doing like development and tenant rep work in South Florida. And I got this phone call from a number, and it changed my whole trajectory of my life. It was just a nice guy. He was one of the founding members of Condor Capital, and they were looking at a portfolio of loans that they could pay pennies on the dollar for. And to me, that was like the light bulb moments. And it is also interesting that I just acknowledge you that in the face of being told this isn't right for you, you not only turned around and said you could have taken that, which, but you turned around and
Yeah.
said, no, I am right. And
Yeah.
now you just made a whole career out of it.
Yeah. Well, you know what? I had nothing to lose. I really had nothing to
That's right.
lose. So what was he going to do? Deny me again? So,
That's right. I
yeah.
love that attitude, Gretchen. I mean, and that's how most of us go through life as if we have a lot to lose by taking chances or saying things. And it's nice that you when you have the freedom to just say what you mean, say what you want to say, even if
Yeah.
it's a risk. It's really phenomenal. It's
Oh,
great.
thank you.
Okay, so let's talk about insurance. I guess we got to actually talk about it, right?
Probably. That's why we're here.
Well, that's right. So this is a very prescient topic. I'm writing a book about insurance and real estate and the cost of capital and the climate and volatility and climate change that's going on. We've seen rates go through the roof in the last couple of years, primarily because the facts are that we're seeing multi-billion-dollar weather events monthly, weekly, as a matter of fact, whereas they used to be, once a quarter. So premiums have been such a skyrocket in the last few years.
Yeah.
Why did it become so costly? Talk to us about that first.
Sure. So how did we get here? So there's two major drivers in how we got here. You mentioned one, climate change. We have not only an increase in the number of storms, but the increase in the intensity of storms. So when a storm hits, there's more damage that occurs. Then on the other side of it, we have inflation. So when that damage occurs, it costs more to repair it. So those two factors together have driven up the cost of insurance. Oh my gosh, 200-300%, sometimes more. So those two factors alone are are essentially causing the insurance crisis. And by the way, I buy a lot of insurance too, so I'm not just selling insurance.
Your customer as well, yes.
I'm a
Yeah.
customer of insurance as well, and my own homeowner's insurance has gone up. So, and it's easy to complain and say, oh, it's so expensive, which it is. And I recognize that. And I complain about it too as a purchaser. But we also have to think on the other side, the carrier that's taking the losses. This hasn't been pretty for them either. Now, I know nobody likes to feel bad for a big, giant insurance carrier that makes a lot of money. But the reality is their losses over the last few years, in some instances, have been greater than 100% of premium. So they're truly taking a loss as well. So I think premiums have been so low for so long that they've not only caught up, but they had to recorrect. So I do think now moving forward, we're going to see a stabilizing. Now, I don't think we're going to go back to where we were, but I think we're kind of at a new normal.
Right. But so it may plateau. We're not going to see a decline unless we see some huge bubble burst in asset values that, maybe could see that, but we'd have bigger problems when that happens. And we could be there.
Yeah.
But it's interesting. So you are expecting premiums maybe to plateau or to continue. Do you think that this is going to continue? People are going to get priced out of insurance. I mean, that's the thing I keep hearing.
Yeah. So, I mean, I'm not the carrier. I don't bear the risk and I don't set the rates. I just, sell, I'm the broker. So you have to understand that I personally don't have any say in setting the rates. But
Right.
what I could expect or what I could recommend is there are ways to lower the cost of insurance. So, for example, diversification. Bill, you have a very diverse portfolio. You're not heavily located on the coast. You're not heavily, we don't have a big concentration in any one location. You have a good diversification.
Right.
So that's going to help you when it comes to your rates. Accepting a higher deductible. Maybe we don't need $1,000 deductible on our homeowner's insurance or on our, per property insurance. Maybe accepting a $5,000 or $10,000 deductible is okay. Maybe we don't need replacement cost value on roofs. Maybe ACV is okay. Now, we can get into the details of what that means if you want, but essentially that means that if your roof blows off and it's 30 years old, well, guess what? You needed a new roof anyway. That's not an insurance loss. You needed one anyway. So, there's ways to structure the policy that gives the buyer a little bit more skin in the game. It makes the carrier a little more comfortable with giving a lower rate.
You mentioned that. Yes, some of the insurers have experienced losses greater than that year's premiums. And what do you say? And well, I'm going to ask you what you say to this. These are also most of these insurers have been building huge nest egg funds that sit on the side, which are making their own money every year as well. So it's not like they don't have a cushion. That was kind of the design of having those set aside. And these are billions and billions of dollars that are set aside. So, and that's what that whole investment side of the insurance industry does is make money off the
I
money.
can't speak to that because again, I am not a carrier and I don't know any specific carrier's financials. You are correct that theoretically that is the idea, that they have a nest egg. But also keep in mind that the carriers that we work with are also buying reinsurance. So their cost.
Oh, that's what I wanted to get to.
Yeah, their cost of reinsurance is also going up. So it's a trickle down effect. So you probably know, most listeners probably know, reinsurance is basically insurance for insurance. So a reinsurer will take a piece of the premium and they'll take a piece of the risk.
My good friend Rick Sharga lives in California, and he talks about this all the time. And, for him, it's a very interesting perspective because you live on the coast. You pay into an insurance company. I think it was State Farm, one of the big ones that was allowed to pulled out. But he literally has had this house with that insurance and that grade A insurance company that he had been paying, I don't know, $10,000 a year for 20 years. So now he paid this company, this insurer, well into six figures, never really had any major claim or anything like that, maybe little things along the way. And all of a sudden one day they get the letter, you're gone. We're out of the state. Sorry, you'll have to find new insurance. And you can imagine what it was like for him to go out and find. He couldn't find it. Yeah, it was not easy to find. It was double the cost. It was a B carrier. It was the government option, whatever the state option is, in certain regards. And it's like if we had known, it's like the gold watch thing, if I had known that I was just going to get dumped before I got the gold watch, then I probably wouldn't have worked all those years for those corporations. That was like our parents' generation, right? It's like the same thing here. It's like, here he is. He would have been better off putting 7,000 to 10,000 away in his own insurance fund for the last 15, 20 years. And that might have actually be worth a couple $100,000 too. Okay, so we have a few more minutes together. I want to hear from you. A lot of investors, real estate investors, small and large, are listening to this, and we're all facing the same issue. Any tips, techniques, more, I'm sure there's some basic stuff that you tell everybody, but anything new that we can think of in terms of ways to lower our premiums, and also along those lines, any changes in the insurance requirements or policies that we as the buyers of insurance need to be aware of from a cost save standpoint.
Great question. So as it pertains to cost, which is, of course, not the most important, but one of the most important things to most buyers. But for real estate investors specifically, number one, we know deductibles. Accept a higher deductible, get some skin in the game. That's number one. Number two, have a great mix of properties. Don't have all your properties on the coast. Have some inland, some on the coast. A good geographical mix is good. Number three, which we didn't really talk about this, but keep your losses low. So if you're one of those insureds that has a lot of little losses here and there, maybe some big ones, but just a lot of losses, when you're up for renewal each year, that underwriter is going to see that. And they're going to say, oh gosh, they have a lot of losses. So sometimes you might want to reserve those losses. If it's a $2,500 loss and your deductible's $2,000, do you really want to claim that? Certainly it's your right. And, you can and you should. But, maybe bumping that deductible up just a little bit helps eliminate some of those little losses that just become nuances.
You gotta, it's like a reputational risk.
Yeah. Right? I mean, that's
for us,
that's the purpose of insurance. And I like to joke around that insurance agents really should have more depression and anxiety, because nobody likes to buy insurance. And then when they go to use it, they don't
it's like dentists.
They don't want to use it either. So we kind of get the bad end of the stick on both ends. But
funny.
But there was.
It's good for. I guess it's good for the insurance companies.
Yeah.
They love to get premiums and have nobody and actually call for a claim.
Yeah.
That's really good advice. And, for people, especially in our industry, what I see a lot in real estate is we all know that real estate, one of the first things I was taught about real estate is very local in nature. And so that applies to insurance too. So that's why you see New Yorkers and Californians that came to Florida 5 years ago thinking it was so cheap, and not understanding the demographics and the other costs that go into living into a place like that. And so same is true with insurance. It's like, it actually is a line item. It's part of the cash flow of any real estate investment, and it's becoming a larger and larger cost that it just has to be part of the calculations. Well, I'm calling you, and even for advice, you're just really great. Thank you for picking up the phone. It's always worked. It's always great to talk to you, and you really your wealth of knowledge. You have saved us some money. Thank you for coming. Have a great day. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.